Did you ever wondered what builds wealth faster, real estate or the stock market? The answer might surprise you. This is my friend Kevin. Back in the day, he was working a 9-to-5 job, living paycheck to paycheck and trying to figure out how to make his money work for him. Kevin had two options in front of him: invest in a rental property or dive into the stock market. He decided to go all in on real estate because, as he said, you can see it, touch it and rent it out for cash flow. Meanwhile, our mutual friend Sarah took a different path. She decided to invest her saving in index funds tracking the S&P 500. Sarah's reasoning: it's simple, hands-off and has a solid track record of long-term growth. Fast forward to today, Kevin owns 3 rental properties. On paper, he's made a decent profit. But if you dig a little deeper, things aren't as simple as they seem. On the other hand, Sarah's investments have grown steadily over time, thanks to the power of compounding. Today I'm breaking down the real numbers behind real estate and stock market investing. We'll look at returns, risk, and how much work each one requires. By the end of this video, you'll know which one fits your goals better. So let's start with the basics. Let's dive into the numbers. Historically, the stock market has delivered around a 10% annual return over the past century. This includes dividends reinvested and adjusted for inflation. In contrast, real estate typically appreciates at a rate of about 4% annually when considering property value alone. However, real estate returns don't end here. You can also benefit from rental income, mortgage paydown, and tax advantages. For instance, Kevin's first rental property, which he bought for $200,000 USD, generates $1,200 USD in monthly rent. After deducting his mortgage and expenses, he nets about $400 USD per month. Over a decade, this consistent cash flow adds up significantly. Sarah, on the other hand, invested $200,000 USD in index funds, tracking the S&P 500. Over the same period, her investment grew to $320,000 USD. The beauty of this approach? It's completely hands-off. While Kevin's cash flow provides a steady income, Sarah's portfolio outpaces his returns overall through pure compounding. The real takeaway here is that both options can deliver solid returns, but the path to those returns is vastly different. Real estate offers multifaceted benefits like cash flow and equity building, while stocks provide simplicity and higher average growth over time. Let's talk about the hidden costs. Real estate often hides significant costs that aren't immediately apparent. Kevin's first property wasn't just $200,000 USD. To close the deal, he had to pay $10,000 USD in closing costs. Then, every year, $5,000 USD goes to property taxes. Add in $50,000 worth of repairs and maintenance over the last decade, and the numbers quickly start to balloon. And those repairs, they're not always predictable. Altogether, these expenses ate deeply into his profits, leaving far less than what he initially expected. Stocks, by comparison, are relatively low cost. Sarah's $200,000 USD investment in index funds incurred an annual management fee of just 0.1% or $200 USD per year. Over 10 years, that's $2,000 USD in total fees, a fraction of what Kevin has spent on property taxes and repairs alone. Another hidden cost in real estate is time. Kevin spends hours each month dealing with tenant issues, coordinating repairs, and staying on top of property management. This sweat equity isn't reflected in his financial returns but significantly impacts his lifestyle. Sarah, on the other hand, doesn't lift a finger. Her investments grow automatically with no time commitment. And here's another big difference: risk. Stocks are often seen as risky because of their volatility. The market can drop 20% in a single year, creating a lot of anxiety for investors. But if you zoom out, the longer you stay invested, the more likely you are to see positive returns. Over any 20-year period, the stock market has never lost money, making time in the market a crucial strategy. Real estate, on the other hand, feels safer to many people because it's tangible. You can see it, touch it, and have direct control over its management. But it's not without risks. Tenant might stop paying, property values can stagnate, and major repairs can pop out of nowhere. Kevin's had some unexpected repairs that wiped out the entire year's worth of cash flow, showing how vulnerable even safe investments can be. Furthermore, real estate risks often correlate with market conditions, such as rising interest rates or an oversupply of rental units, which can negatively impact profitability. These factors make real estate less predictable than it might initially appear. On the other hand, real estate does have one big advantage: Taxes. Kevin gets to deduct mortgage interest, property taxes, and depreciation, which reduces his taxable income significantly. Depreciation, in particular, allows Kevin to lower his taxable income without spending additional money, effectively giving him a cash-saving tax shelter. Furthermore, when Kevin eventually sells his property, he can use a 1031 exchange to defer paying capital gains taxes if he reinvests the proceeds into another property. Stocks, on the other hand, are taxed differently. Sarah pays taxes on dividends as they are distributed, and on capital gains when she sells her investments. At the end of the day, while both real estate and stocks can build wealth, stocks often come out ahead for most investors due to their simplicity, higher average returns, and fewer hidden costs. For those who value a hands-off approach, the stock market's long-term stability and accessibility make it a compelling choice. But at the end of the day, the most important thing is to start invest now. Because the real secret to wealth, it's not timing the market, it's time in the market.